Hello, in this lecture we're going to define the term of book value. According to Fundamental Accounting Principles, WOW 22nd edition, the definition of book value is assets acquisition cost less its accumulated depreciation or depletion or amortization, also sometimes used synonymously as the carrying value of an asset. Let's break that down a bit. We're talking about the asset's acquisition cost, what we purchased it for, less its accumulated depreciation. So we're typically talking about property, plant, and equipment type of assets, assets that have a longer life, assets like equipment, assets like a building, and we're going to put them on the books as an asset in accordance with the accrual principle because they're going to help us generate revenue in the future. We do, however, need to reduce the value of those assets as they have been used up in accordance with the matching principle because these assets do deteriorate in value. Therefore, we're going to create another account called accumulated depreciation in the terms of property, plant, and equipment, and that will be the reduction of the value of the assets so that in order to calculate book value, we would say that we have the cost less the accumulated depreciation. If we're talking about intangible assets, then we're talking about something like amortization, often having to do with some kind of legal asset, such as if we have a copyright or something like that. That's a type of asset. It's not tangible. We cannot touch it, but it still may amortize, and we're going to have to record that amortization of something like that. If we're talking about depletion, we're talking about something like land that, say, has oil on it or something like that, and as we drill the oil and take the oil out of the land is then being depleted of the oil, and we would record depletion in a similar way. If we take an example, we're going to take the example of a property, plant, and equipment. We're going to purchase the property, plant, and equipment at $15,000, and we're going to put it on the books as an asset. Then we're going to write off the depreciation resulting in accumulated depreciation representing the depreciation over the useful life so far. In this example, it's $6,000. Therefore, the book value, 15 minus the 6, would be 9,000 in the book value. You might be asking, why don't we just write down the equipment directly? Why do we need this term accumulated depreciation and another account named accumulated depreciation? One of the reasons for that is it tells our reader a couple things. It tells our reader, hey, we bought the equipment for $15,000. We wrote it down by $6,000, representing the cost allocated over what we believe to be the useful life. However, it is just an estimate. We don't know exactly what the fair market value is at any point other than the point of purchase, because that's the only time that we purchased it on a free market, determining that at that point in time it was worth $15,000. Everything past that point in time is just an estimate because we don't have the market forces to tell us exactly what the fair market value is. That's why we have to make this estimate of book value. That's why we tell our reader what that estimate is through having both the cost on the books as well as the accumulated depreciation on the books.